So pretty simple this week. We only have 4 questions, right?
Yes.
Yes.
Sweet. I know. That was like perfectly in tune. All 3 of you at the same time was like, yes. It was awesome. My wife's over here, and she was like, they all said it at the same time. That's funny.
Okay.
So question number 1.
Mm-hmm.
So what value would you place on RightNow Technologies?
I was looking at the post-money valuation. So 129 million is the amount that I would say.
Yeah.
Yes.
And what I kind of did to like place a value on the company as well, I always have to like keep flipping this sheet around. But oh, whoops, I flipped it the wrong way. Lovely. Okay, so on Exhibit 4, it's got like different companies that were sold, I think, and it has like the price and their revenue, and then like the multiple of the revenue, whether they sold for like 2 times the revenue or whatever.
Yeah.
So I kind of like averaged those out, and it came out to be like 2.44. So I just said like anywhere between 2 times to 3 times the revenue would be pretty reasonable, which is like $70 to $105 million, which is what I was kind of thinking to place a value on a company. But
yeah, that's actually that's a good way to think about it, because I mean that actually does seem very accurate.
Yeah, that's kind of what I was thinking.
I was thinking about valuing the company based on the assets the company owns. Actually, it was around $30 million, because I was reading a little bit about how we can provide an accurate valuation to a company. Because if we evaluate it more times than the revenue is, this company is growing in revenue generation, but as well the net income, we're having like just some ups and some downs, because in some years they have like 5 millions losses, and some others they have 4, and some others 2. So revenue isn't really providing an accurate amount. So I was thinking just to base it on what the company owes actually, and it was $30 million.
Okay. They have an offer of 50 million, right? The offer that they are making. They are receiving an offer for.
Was it 50 million? I don't remember.
I don't remember that price.
I remember seeing a number.
Mm-mm.
Let me see if I can find where it's.
Let me see.
15.
Oh wait.
They said revenue and
Well, it says it sounded as though the acquirer was willing to pay this multiple on RightNow revenue run rate, approximately $50 million.
$50 million. Mm-hmm.
Rather than the company's trailing 12-month sales of $35 million.
Mm-hmm.
Where's that at? I'm curious.
It's page number 8.
Page 8, that's at the bottom part.
Yeah.
Awesome, thanks. I want to see that. I think I remember reading that, but I just couldn't remember for sure. Oh yeah, that's right. Cool.
So what I'm looking at is that with the calculations is about the same amount. Calculation you made. Mm-hmm. So it's probably around that. And they are receiving a very good offer, no?
Based on their balance sheet, yes.
Yeah. So that's exactly right. So it's saying like it says see Exhibit 3 for valuation data on selected companies, Exhibit 4 for data on recent software mergers and acquisition transactions. So yeah, that's interesting.
Mm-hmm. Yeah.
So yeah, I think we've kind of kind of placed a value on the company then.
Mm-hmm.
All came up with some different ways to do it, which is definitely reasonable. So if we had to like create, because question number 2 was, please provide a range of values rather than a single number. How did you come to this conclusion? So what would be a good range of numbers that we kind of talked about?
Well, between 30.
Go ahead.
I mean, the bottom will be about 30 million, right?
Yeah.
Yeah, I would think so.
Mm-hmm.
And then I think, I mean, I think they could, at the most they could do, based on like looking at some of the other mergers and acquisitions in Exhibit 4, if they were to sell 3 times their revenue, which would be difficult, but if like that would be about $105 million at 3 times their revenue for 2013. So I mean, we could just say like anywhere between 330 to 100, which is kind of a large section. I don't know if we want to narrow that down at all.
Mm-hmm.
What are your guys' thoughts?
Well, I was just making my hypothesis based on the net income they had, because from 1999 through 2003, I was mentioning they were having around the same loss amount. In 1999, it was 2.4 million, and in 2003, it was 4.1 million, even though their revenue generation was going up from 2 million to $35 million. So they are having revenue, but in conclusion to it, they're increasing their liabilities. So that's making a very good management inside the company. So that is why I'm making a valuation of $30 million, because even though they were growing, they were not having actually profits, because they were having losses every single year. They went from 2 to 19, and then to 15, then going down to 2 million, and then going up again to 4 million. And that one was the year having $35 million total revenue, and they have a forecast for 2004 for 60 million. So thinking the net income loss can increase or can go, or that one can go down as well. So that I base my calculation on by just giving them based on their current assets.
Okay.
I mean, I think it's a good range.
Mm-hmm.
Awesome. Yeah, looks good. Sorry, I'm like sitting there with my head tilted sideways. You think you could just push a couple buttons to switch it back and forth, but for some reason tilting your head sideways is a lot easier. Yeah, no, I think that's a great range. Obviously, like it could go on the higher spectrum or on a definite lower spectrum of that, but yeah, I think that's a good range. So number 3, I guess. Moving on to number 3.
Yep.
So if Greg's investors seek a 30 to 50% internal rate of return, what exit value will they expect? What are my notes? So for me, at least, if they're expecting like a 30 to 50 internal rate of return, well, their first investors, when they did that Series A funding, it was for 16.9 million. So I just did 16.9 million. I don't know if this was right, but 16.9 million times 1.3 and 1.5 to come up with a range of 21.97 to $25.35 million that their investors would be expecting for an exit value. Well, oh, sorry, but then that would be how much they're making. Wait, no, I'm confused. I'm confusing myself now. There. Well, how did you guys do this one? Because I just.
I'm a little stuck on this one.
I just read that it is the ratio of the yearly income from an investment to the original investment. It says in here the initial amount received or payment, the amount of subsequent receipts or payments, and any final receipt or payment all play a factor in determining the return. So I think it goes with as well. It has something to do with what you were mentioning, Kyler. The amount they are making. So based on the investment they are made, they're hoping to get 30 to 50% of that money going back as well, besides the amount they are making, I can think of.
Yeah, because I mean, yeah, I just times it by 1.3 and 1.5 million to come up with a range of what they would expect. But that seems too simple. But I don't know. Maybe that's right.
Yes, I was kind of thinking the way to calculate this one, and I was just thinking about the same based on the amount they are able to make based on that calculation to get 30 or 50% of that money as their internal rate of return besides the money they are raising. But I'm not quite sure, but I was thinking of it.
Yeah.
I'm not really sure what to do with that one.
Well, exit value is the proceed if an asset sold.
What was that, Luis? I didn't get that. It cut out a little bit.
Okay. Exit value is the proceeds if an asset or business were to be sold. This estimated amount is considered to be the most reliable if the proceeds are derived from an independent third party in an arm's length transaction where the sale is not rushed. That's what we must consider.
Okay.
So then we must calculate how much they will get of that sale if they sell the company, how much they will get at the end. Is that what it meant?
Yes.
So
Yes.
based off that range amount?
Because if they will sell the company by a range of $50 million, getting 50%, that's 25 million. Based on the 16 million investment they made, that's half of the sale. Or the 30%.
We get 35 million for the 30%.
So that's a lot of money.
Nice. So should we use then the 50 million as kind of what, like, so if they get the buyout for 50 million, that they would receive is 25 to 35 million.
Yeah, that's it.
Yeah. Wait, so why is it 25 to 30 million again?
So this is based off, so you take the 50 million and you do 50% of 50 million, and then you do, what was the other one, 30%?
30%. Those are 15 millions. That's 15 to 25.
And you just subtract it from the 50.
So is a 50%, is it referring to like 50% of like the exit value, or is it referring to 50% more than their initial investment?
The exit value, I think.
Because
and there it says what exit value will they expect?
Yeah. So
it's what they are expecting to make.
Yeah. So I don't think they're expecting to make 50% of the sale, are they?
No, well, the question is seek to 30 to 50% rate.
That's what they are looking to get.
Yes.
But what this guy of the company mentioned, that regardless the option he will decide to go with, he wants to remain at least with 60% equity. So I think the most reliable one can be a margin of 30%, or within 30 to 40% what the investor will get as the exit value.
But you have a Series B investor too. Is it talking about both? Oh, okay. If Greg's investors. So then how do
So
you
wouldn't it
split
be
up the
referring to
10
both
million?
investors?
What's that?
Sorry?
It would be referring to both investors, right? Because there's one for 16.9 and then the Series B for 16 million.
Right.
Yeah.
And I'm just wondering how you would split that then.
Mm-hmm.
I guess it's not asking for that. So
this one was kind of, I don't know. It was confusing for me. I was thinking for different amounts, but I didn't come up with a reasonable answer.
Yeah, I might just email Brother Nebaker on that one. Just ask for like pointing us in the right direction. Because like just looking up like internal, I'm just kind of talking to myself now. Yeah. All right, maybe we just move on from that one.
What I think is that if they are investing 16 million, we must consider in Series A and in Series B the exit value.
what's that? You can't cut out.
Yeah, you're
Yeah.
cutting out again, Luis.
Uh-huh.
I beg your pardon?
You were
Yes,
cutting
can you-
out.
Uh-huh.
Well, what I was saying is that we must consider the Series A and Series B value.
Mm-hmm.
Okay. The amount that we are talking about, the 30 to 50% internal rate of return.
Okay.
Those are the amounts. Somebody's doing the dishes.
The dishes. I actually enjoy doing dishes because it's just a simple task, and I usually just turn on music, and it's just relaxing. You sit there and like you don't worry about anything else but doing dishes.
Okay.
Okay. So do you want to move on to question number 4?
Okay, yes.
Yeah.
It says just provide your analysis of which of the options Greg is considering. Based on your analysis, what should Greg do? Consider Greg's goals as well as the goals of everyone else who is involved in this venture. So the first option was, let me move
The
it down.
first option was receiving
Accept the acquisition
Yeah.
and grow within a larger organization. What he was mentioning about this option in here in the second paragraph, it says that he is looking to get a market-leading solution breadth, securing widespread distribution and enhancing the visibility of the company. So going with the acquisition to go into a higher market will provide him with these 3 improvements of the company, because they have a good service and product, but what they are missing is just to go out and do more, because they have not too much visibility. So that is why they are having revenues, but as well their operating expenses are too high.
Right.
So for me, this is a very good option.
I ended up going with the IPO, and it does seem a little risky, but it mentioned that, so it says, let's see, I said the IPO would give them the visibility that they need, and hold on one sec, let's see. My other reason. And I ended up looking it up afterwards after I made the decision, and they ended up raising 44.1 million in a successful IPO in 2004, and then they sold in 2012 for 1.5 billion.
Whoa, that's crazy.
Yeah. But yeah, I said an IPO just because I think all they need right now is visibility, and they have a competitor with Salesforce that's now becoming larger, and so yeah, they either have to sell it or go public and get the visibility. And I think if they just keep going with the organic growth, then they'll die out. So I do think the two best options would be to either sell it or to go with IPO. And I just said IPO, my decision. And I also mentioned that the investment banks wanted RightNow to go public. So
yeah, that's what like influenced my decision, Kevin, was how somewhere it said like if he were to offer an IPO, he had plenty of investment banks that were just like chomping at the bit for this deal, like they wanted it. And that way they're not partnering with one of the enemies, so to say, that it says in like the thing, and like affecting like the company morale. So I was kind of agreeing with you on that, how they should go with an IPO and try and get that visibility, because it was saying if they went with an IPO, then they start getting noticed by Wall Street and these other like software journals or whatever that gets them out there a little bit better.
right.
Yes, that could be. But how do you think about the 4 points which is mentioning under the option for an IPO in 2004? It says on page 10.
Yeah,
It
right at the
says
top.
Giant believed that there were 4 key factors that would keep them from competing well in the on-demand CRM space. For example, to rewrite their software, and also the ease of implementation of the on-demand model would obviate the need for the layers of consultants and surrounding the big CRM players. How do you think going with an IPO will handle these 4 factors that will keep them to compete going with an IPO?
At least for like the first one, they already kind of rewrote their software once, and they were planning on doubling their what I don't know. I don't remember what force he called it. But he said they were going to double like their programming force. I don't know what they called it again.
Salesforce.com.
Was it a Salesforce or?
Oh no, that was the competitor, Salesforce.com.
Okay.
But yeah, they talked about how they were going to just basically grow their product development team or their programming team.
Oh, their engineering team.
Yeah.
Yeah. So in 2002, he told Mike Meyer to double the size of his engineering team. So I mean, with double the size of the engineering team, I feel like they'd probably be able to rewrite their software again, and implement it as they go on. And number 2, that's an excellent point, Kevin.
Because this was the thing that was preventing me to go with this option, because an IPO, it's a very good option, but this will take them, I don't know how much money will take them to rewrite the software to go with all these implementations to improve their customer satisfaction and all of this. So that's why I was going to get someone which already has those areas in the market, will help them to grow faster than just creating an IPO, which is taking around 3 months to start the process, and then going with the public offering. But I don't know. That's my perspective.
Well, another
for
thing
me,
too, a lot of their money that they spent, that they were losing, was going towards sales and marketing. It was 20.8 million in 2003, yet they were still negative with net income. And I think their problem is maybe their sales and marketing team just isn't good. And once they go public and they get that visibility, then they'll start, having positive. They'll have a positive net income.
Yes, I think these 2 options have pros and cons. That I was thinking of both, but going with the first one.
I was thinking from I'm older than you guys, and I have probably another perspective, but I think that Gianforte is going to go for the acquisition. He's an entrepreneur, and he says some part I read, he doesn't enjoy managing a company. He's more like the kind of guy who wants to create something. He moved to the mountains or to Montana, nothing, just to live a quiet life. Okay, but he likes to create. He's a creator, and I think at this point it's easier for him to sell and maybe to create something new that to go in all the implication that it is going to an IPO or keep the company growing. But that's my perspective. It's somewhere I read that it says that he already have enough money for his retirement, so he's going to have even more money to create something new that which is that he really enjoys. I don't know if that's that why what I enjoy, that's what I will be pursuing. After 10 years, they have this company for 6 years already, right?
Mm.
Yeah,
So
about that.
he probably he probably wants to move to something new. But that's my idea. That's what I can read as an older guy. That's what I will be doing, right? I sell and then I create something new. I don't want troubles to well all that implies to go APO and negotiation and more negotiation and all that. But that's my opinion. And based on the numbers, he's going to receive a very good amount. He started the company with $5,000, I think.
Yeah.
Yes.
Okay, so he did a pretty good business then, so far.
Oh yeah.
And mine was actually kind of similar with when I was thinking about that. But I went the IPO route because of that. So he mentioned when he actually retired before, and then he kind of was like bored and he needed something to do. And I figured this is why he'd want to keep seeing the company grow. Plus, he wanted to build more jobs in Montana. So if he keeps going, then he could, grow, add more jobs in Montana. And I think it mentioned that he only had added 500 or I can't remember, but he wanted to add 2,000.
He was missing 1,600.
Yeah.
Yeah. But there's no more people in Montana also.
Yeah, that's true.
That's another thing.
Yeah.
Okay, so I think we. I mean, I'm still thinking going with the first and the second option, because then the 2B, I don't think that one will go with anybody reject the acquisition offer and continue to grow organically.
No.
It says that will take some years and even decades to grow at a level of a different company such like Siebel or any other companies. I don't think that's a good option.
I don't think it's a good option because Salesforce is coming in so fast, and if they don't get visibility, then they'll be taken out fast.
Exactly, because Salesforce was also going public. They're going to offer that IPO, and by doing so, they're going to just wipe out RightNow.
Another thing that makes me consider that he's going to sell is because he's always looking to have the 60% of the company, right? And once you get public, you have a great possibility to lose that 60%.
Yeah, definitely.
I mean, once that you go public, the company is not yours anymore.
That's true.
Even if you are directing the company, there's a risk that somebody else is buying the stock, and you're going to lose the control of the company.
Right.
Sooner or later.
Yeah. And I had one question. So if he took the acquisition, it was saying that the acquisition was only in stock. Is that right?
Yeah.
Yeah. So it was just in stock. So it wasn't like a cash offer. It was a stock option. So it was more like almost like a merger more than an acquisition, but obviously an acquisition because they're being offered or they're getting the offer from like a bigger company that's going to put a big name on RightNow. But they're not like getting any cash out of that at all. They just have to hope for the best that that's going to put a big name on them, and they're going to be able to increase their revenue doing that. But if they did an IPO, they're going to start getting cash from that. They can have positive cash flow at that point and increase their growth at the same time.
That's a good point. My perspective by going with the first acquisition offer was because they were going to get the 3 things the company needs. And even though there's not going to be any cash instantly, because he has already the money he needs to live with. So by going with the 3 things the company needs, he will be able to raise quite more money by going in a larger organization. It's more and more and more and more than just selling it out, because that doesn't mean acquisition does not mean to sell the company actually, but just to sell part of the company, but such as an investment, but also making his own company to grow, and by growing the company, the sales revenue will increase, income and the balance sheet will be positive and increasing year by year. So that was my position, because he has the money he needs.
Right.
So what he wants is to make this company greater than it is.
Mm-hmm.
So it no longer becomes his. I mean, he was almost working for somebody at that point.
That could be in the long run. That could be.
Yeah.
So then, what will be the conclusion?
I think it's fair to say that there's no just one right answer on this. I feel like obviously all of us have an excellent point of views on this, and I mean either one of these decisions could be a great decision at this point. So I think it's fair to say that both are right.
Yeah.
So you, Kevin, said that you look on internet what the company keep ending doing, or?
Yeah, so they ended up going with the IPO route in 2004, and they were able to raise $44.1 million, it says, in a successful IPO. And then in 2012, they sold their company to Oracle for $1.5 billion.
That's insane. That's crazy.
Yeah.
After
that was
successful
in the
IPO.
end a good option. Mm-hmm.
Yeah.
It certainly was. So we can take that as our conclusion then, because they made it. It was their company.
Yeah. Awesome. So should we just do a quick summary then, kind of?
Okay.
Yes.
Yeah, sure.
So question number one, what value? I guess kind of number one and question and number two kind of just like mixed together. Like, what value would you place on RightNow Technologies, and like not using a single number? I think we agreed on anywhere between like 30 million to like
50 million
to 50 million.
30 to 50, yes.
Yeah, 30 to 50 million.
Because that was based on the balance sheet having losses currently and also in their current assets and the offer they got, so making it an average.
Yeah, okay. And then number three, if Greg's investors seek a 30 to 50% IRR, what exit value will they expect?
25 to 35 million.
Yeah.
Around that amount.
Okay.
Within 15 to,
And then number four, which analysis? We kind of decided that going with the first or the second option would be a good analysis or a good decision for this case. Both had great point of views, great sides for both of them, and either decision could be a good decision for the growth of the company.
But after seeing the real numbers and the offer from Oracle, we need to go for the IPO.
Yeah. Yeah. Awesome. Okay. Well, I think we can call it good with that. I'll send you guys the link so that we can put it in the post discussion board thing.
All right.
Okay.
All right. Cool.
Thank you.
Thanks a lot, guys. See you later.
Next same time?
Yeah, next
Tuesday.
Tuesday, because we don't have a case the second half of the week.
Okay.
Awesome.
Thank you, guys.
Okay, see you guys.
Bye.
See ya.
Bye-bye.
Bye.
Bye-bye.